Hello everyone, welcome to series of webinars on Advanced Taxation course organized by ACCA. I'm Owais Mirchawala and today is our day 2 on the webinar sessions. As you all know that yesterday we started with the discussion of a complete past paper of March-June 2022. In the yesterday's class we completed with the question number 1 and I shared the answer with you people also. Those students who were not able to join yesterday can find the summary notes and the yesterday's question solution in the handouts tab. Today we are moving towards question number 2. I want you all to concentrate and listen to me very carefully. Let me give you a brief overview before moving towards the today's question. In the previous class, we discussed that your strategy in the last 1 week of the exam should be that you should be revising your rules through these summary notes. Okay, we had a discussion that these summary notes can help you in the revision of the entire course, and along with that, you have to do the complete past papers. We were discussing the complete paper of March-June 2022, and I also told you people that you can access my other free resources relating to past paper sessions on my YouTube channel. These past paper sessions will help you a lot in learning the exam technique. Today we are moving towards question number 2. I want you all to concentrate on it. We will draft the complete answer and we will look at the exam technique, that how you have to deal with it in the exam. This is the most recent paper. Okay, now you should assume that today's date is 1st May 2022. Your manager has received an email from Hogan, a new client of your firm. Extracts from the email and from an email from your manager detailing the work you are required to do are included in the exhibits. So some basic detail is given that we are working for a client, Hogan. The work to be carried out is in respect of the income tax payable in respect of both the UK and the overseas income. A receipt of shares from share incentive plan, a sale of house situated in overseas, and a gift to a discretionary trust. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Email extract and email extract from your manager. Okay, so let's look at it. Email extract from Hogan. Now, let's read it. For the last 30 years, I have been living in the country of Baltira, moving to the UK. I have entered into the employment contract with VPR PLC, a UK-based company. I will move to UK to commence employment on 1st August 2022. I will buy a home in UK on 1st October 2022 and will live in rented accommodation until then. So now, Hogan has been living in Baltira for 30 years. He will return to UK on 1st August 2022. Now, you all know that we return to UK for a permanent employment, we become UK resident immediately. If we come to UK with an intention of permanent employment, we become UK resident immediately. So he will return to UK to commence employment on 1st August 2022. Let's read further. Employment contract with VPR PLC. The contract is for a minimum period of 4 years. Under the contract, I will earn a salary of £16,500 per month. In addition, I will become a member of the company's tax-advantaged share incentive plan. On 1st May each year, this share incentive plan will award me free shares in the company. The value of these shares will be between £1,500 and £2,500 each year, depending on the performance of the company. I have been told that the receipt of these shares together with any dividends declared in respect of them, will not give rise to a tax liability in the UK. Now, if you all remember the rules of share incentive plan, in share incentive plan, you can get free shares. In share incentive plan, you can get free shares, and it will not create any tax implication if you retain those shares up till at least period of 5 years. If you dispose them after 5 years, then there is no tax implications. Now, if you have forgotten any rules, as I told you in the previous class, you can simply go to the summary notes. You can write share incentive plan in the search and you will get the rules here. Okay, you can get free shares up till the maximum value of 3,600. Okay, you need to keep the shares for the period of at least 5 years. Okay, if you are receiving any dividend, that dividend will also be exempt from tax if you use that dividend to purchase further shares. So while you are doing the past papers, reference to the summary notes can be an easy help for you. Okay, these summary notes cover maximum of the rules. Almost all the rules are covered in it, but if you find that any small thing is missing, you can update in it. Okay, so free shares can be given up till value of 3,600. So here, if you read, they are giving her free shares between £1,500 to £2,500. So that is within the acceptable limit. There will be no tax liability if these shares are retained for a period of at least 5 years. Okay, and if the dividends are also used to purchase further shares, then dividends will also get exempted from tax. Assets in Baltira. I own two properties in Baltira, my current home, the Pink House, and a rental house, Sea Breeze Cottage. The Pink House. I will retain this house and rent it out from 6 July 2022 for £3,200 per month paid in advance. This amount is after deduction of allowable property expenses. Then there is Sea Breeze Cottage. See, I always say to my students that when you are doing the first reading of the question, don't rush. Just read the points, identify the things. We'll read the entire question, then we'll go to the requirement, and then we'll get back to the relevant parts again. So this is first reading of the question. So don't rush, don't move towards conclusions that it's difficult or easy. Every question is easy if you will read the requirements carefully. The tenant moved out of the house on 28 February 2022, and I intend to sell it. The sale proceeds would be £670,000 if I were to sell the house now. However, I have been advised that if I were to delay the sale until June 2023, the sale proceeds would be more than 670,000 and could be as much as £800,000. I paid £360,000 for the house in 2014. And then there is detail relating to trust. I am planning to create a UK discretionary trust for the benefit of my two nieces. On 1st July 2023, I will give £380,000 in cash to the trust. The cash will be transferred to the trustees from my bank deposit in Baltira, and I will pay any inheritance tax due in respect of this gift personally. I have not made any previous lifetime gift. So we have read this email from Hogan, and it was just bulk of information. We have got a lot of information. Okay, we'll read the email of the manager and then we'll look at the requirements. Okay, let's look at it. Email extract from your manager. I want you all to concentrate on it. Additional information, Hogan. Hogan was born in UK and has a UK domicile of origin. He is currently neither domiciled nor deemed domicile in the UK in respect of all taxes. but you should bear in mind that domicile status may change over time. Now, you all should remember that if you have the domicile of origin, you can come into the rules of deemed domicile. In deemed domicile, we call them as formerly resident rules. I hope you all remember that if you had originally the domicile of UK, if you had the domicile of origin, you can become deemed domicile if you are resident in that particular year. Okay, we look at them while we'll be solving the question. The split year basis applied to Hogan in the tax year 22-23. Do anyone remember that what is a split year basis? If anyone can tell me on the chat box, what is a split year basis? Split year basis means that you will become resident during the year. The split year basis means that you become resident during the year. This happens when you come to UK with permanent intention or with a permanent employment. Now, if you look at the situation of Hogan, I already highlighted to you people that Hogan will move to commence employment on 1st August 2022. So he will become resident on split year basis. He will become resident during the year. Okay, what do you mean by split year basis? Split year basis means that your residency status will change during the year. The 183-day rule, the 365 days rule, those rules will not apply. Your residency status will change immediately. And this happens when you move in or move out of the UK with a permanent intention or with a permanent employment. Okay, so he will be split year resident from 1st August 2022. So if you read it here, the split year basis applied to Hogan in the tax year 22-23. You are not required, read it carefully, you are not required to provide an explanation as to why this is the case. You are not required to think the reason that why split year is applying. You just need to understand that he will become resident through split year in 22-23, which means that he will become resident from 1st August 2022 when he got the employment. Okay, when he got the employment. Now, what else he's saying? Hogan will be UK resident in the tax year 23-24. The remittance basis is not relevant to Hogan as he will remit all of his rental income and the proceeds from the sale of his overseas rental property to the UK. This means that you are not required to think about remittance basis and remittance based charge issues because he'll remit all of the income. So obviously he'll go for arising basis because if he'll go for remittance basis, he'll not get any benefit of it. Okay, so you are not required to think about the remittance based charge and the remittance basis things. The tax system in the country of Baltira. Hogan's rental income will be subject to tax in Baltira at the rate of 45%. Chargeable gains are calculated in the same way as they are in UK. However, there is no capital gains tax annual exemption in Baltira. CGT is charged at the rate of 4% on disposal of assets situated in Baltira, regardless of an individual's resident status. So the income tax rate is 45% and the CGT rate is 4%. There is no IHT in Baltira. There is no double tax treaty between UK and Baltira. Okay? Now, please carry out the following work. Part A. Hogan's income tax liability for the tax year 22-23. Calculate the Hogan's income tax liability for this tax year. You should include an explanation of the amount of Hogan's overseas property income, which will be subject to UK income tax in the year. So first of all, we have to calculate his income tax liability. If you look at the requirement, How much marks are available to this requirement? Carry out the work as requested in the email from your manager. The following marks are available. So for Part A, Hogan's income tax liability for the tax year 22-23, we are available with 8 marks. So we have to calculate his income tax liability for the tax year 22-23. Okay, I want you all to concentrate on it while I develop the answer, and I want all of you to participate with me also and give your suggestions. Okay, just a second. Okay, just a second. Let me give a reply to one student. Okay, now let's start. Hogan's income tax liability for the tax year 22-23. Okay, now why we are calculating the link for the yesterday's recording that is available on the ACCA YouTube channel. You can access it from there. Okay, you'll just go to YouTube and you'll write ACCA Pakistan. You'll get the yesterday's recording there. Okay, I'll also share you on the WhatsApp group after the today's class. Now, so we have to calculate the income tax liability of Hogan for 22-23. Now, first of all, what you need to understand is that Hogan became UK resident from 1st August 2022. Okay, because split year basis is being applied. He got permanent employment in UK on 1st August 22 and he became UK resident from that date. Now, under the contract, he will earn a salary of 16,500 per month. He will be getting a salary of 16,500 per month. So August, September, October, November, December, January, February, and March. He will get a salary of 8 months. He will get a salary of 8 months, which will be his employment income. The share incentive plan will not give rise to any tax liability. The share incentive plan will not give rise to the tax liability. Okay, then the pink house, I'm looking at his incomes because I have to calculate his income tax liability. I want you all to please listen to me carefully. I will retain the house and rent it out from 6 July 2022, okay, for £3,200 per month. Now, this pink house is in Baltira. It is an overseas income. What you need to understand is that it is an overseas income. Now, the overseas income will start from 6 July 2022, but he will become resident from August 22. So the property income after that date will only be taxable. The property income after that date will only be taxable. Okay, listen to me while I draft the answer. First of all, we have to calculate his income tax liability. Calculate Hogan's income tax liability for the tax year. First of all, let's calculate his income tax liability. I want you all to concentrate on it. I will add a table here. Okay, now the income head is non-saving income, and here I will add the comments. Now he will get employment income. Now what will be the employment income? Can anyone tell me? It was 16,500 per month. Okay, 1st August 2022. Let me add the symbol of pound. £16,500 into 8 months. So how much? As all the students have sent me on the chat, 132,000. Then there will be property income, overseas property income. Okay, what is the amount of overseas property income? It's £3,200 per month. The property income has started from July 22, but I will not take it from July. I will take it from the date we became resident. So we will take it for 8 months only. It was 3,200, sorry. £3,200 multiplied by 8 months. Can anyone tell me? 25,600. Okay. Okay. Two students have said different numbers, so let me confirm it. Yes, it's 25,600. And then there is one more property, Sea Breeze Cottage. Okay. The tenant moved out on 28 February 22. So no rental income in 22-23 because the tenant has moved out in the previous fiscal year. Okay. Now, one student has said comments, even the house was given on the rent in July, but UK tax will apply from August. Yes, it will start from August because we became resident from that date. Okay. Now, so our total income will be, can anyone tell me? 132,000 plus 25,600. So it's 157,600. Okay, now there will be personal allowance, but obviously the personal allowance will diminish to zero. Can anyone tell me why personal allowance will diminish to zero? Can anyone tell me? Will diminish to zero because, yes, because the income exceeds the threshold amount. Now, when you exceed £100,000, your allowance diminishes by £1 for every £2 excess. Now see, your personal allowances, is 12570. Your personal allowance is 12570. Multiply it by 2. So if the excess is of 25,140, your personal allowance will diminish to 0. Okay, the limit is 100,000. I will repeat it again. Normally the students know this rule, but if someone do not remember, let me make it very clear. See, the limit is 100,000. Okay. Now, if the income exceed 100,000, the personal allowance start to diminish. It diminishes by £1 for every £2 excess. So your personal allowance is 12570. It will diminish to 0 when your excess is of 25140. So personal allowance will diminish to 0 because income exceeds 125,140. 100,000 is the limit and 25,140 is the excess when personal allowance gets diminished. Now, these are the small things for which you need to hold expertise and you need to remember them carefully. So now your taxable income is 157,600. Okay, now let's apply the tax on it. Let's apply the tax on it. Income tax. Now, you all know that your tax band is 37,700. You will apply 20% on it. 37,700 into 20%. So it's 7,540. Then till 150,000, the rate is 40%. Okay. So 150,000 minus 37,700, you will apply 40%. So it's 44,920. And then on the remaining 157,600 minus 150,000, you will apply 45%. So on 7,600, it will be 45%. So it's 3,420. So your income tax is, can anyone tell me? 7,540, 44,920, and 3,420. It's 5,5,880. Now you need to think about one thing, which is double taxation relief. Can anyone tell me why we are thinking about double taxation relief? Can anyone tell me that why we are thinking about double taxation relief? See, here it was written that Hogan's rental income will be subject to tax in the rate of 45%. So this shows that there is some overseas tax. Okay, and when there is no double tax treaty, we calculate the double tax relief at lower of two things: UK tax and overseas tax. When there is no double tax treaty, we calculate the double tax relief at lower of two things: UK tax and overseas tax. Now, the Hogan's rental income will be subject to tax in Baltimore at the rate of 45%. Okay, so let's calculate the double tax relief. Double tax relief. DTR will be available on overseas rental income at lower of two things. Number one, overseas tax. Now the overseas tax, the amount is 25,600. 25,600 into 45%. 25,600 into 45%, it's 11,520. And UK tax on overseas property income. See, what I want to illustrate is that it is not difficult. You people are telling me the answer on the chat box. Okay, you people are telling me it's not difficult. It's just a simple piece of work. Okay, now what you people do is that when you go in the exam, you people mess up in these easy things. You people mess up in these such an easy concepts. And why do you mess up? Because you rush. Okay, one student has asked that, sir, why didn't you took rent from 6 July 2022? Because I became resident from August. I know that the rent is coming from July, but my UK residency status will start from the date I took up the employment. Earlier that date, I was not a UK resident. Okay. Due to split year basis, I will become UK resident from the date I took up the employment. Okay. Now you are done with employment income, overseas property income, total income. The personal allowance was diminished to zero because the income was exceeding the 100,000 breaker by 25,140. Then we calculated the tax. Now we are going for UK tax. Now see, this is one of the area where students make a slight error. But believe me, this is very easy if you look at it carefully. See, the overseas tax was 11,520. The overseas tax on this income is 11,520 at 45%. Now I want to pick up the UK tax. How will I pick up the UK tax? Now in UK, I will tax this income at higher rates, at the maximum rates. Listen to me carefully. In UK, I will tax this income at maximum rates so that my DTR gets maximized. Listen to me. The overseas tax is at 45%. It was given in the question. The overseas tax was at 45%. It was given in the question. Now in UK, I will tax it at maximum rates. Now how? See, 7,600 was taxed at 45%. The maximum rate, I will pick up the last slices. I will pick up the last slices. 7,600 was taxed at 45%. If you remember the rule of double taxation relief in individual overseas, you should remember that in UK, we tax overseas income at the last slice, at the maximum rate, so that the DTR gets maximized. On 7,600, the tax is 3,420 pounds. On 7,600, the tax is 45%, which is 3,420 pounds. The rest of the amount, what is the rest of the amount? 25,600 minus 7,600. The rest of the amount will go into the second bag. See, if someone is getting confused in this rule, this is one of the topic which is bit difficult when we study it. I know that some students have given me the answer in the question tab, but some students may have got confused in it. When we are calculating the double taxation relief, we tax overseas income at the highest slice. We tax it at the end portion so that the DTR gets maximized. See, if I will tax this 25,600 in UK at 20%, my DTR will get reduced. So I'm taxing it at the last portion. I'm placing it at the end portion. So 7,600 at 45% and the remaining amount at 40%. Okay. So 25,600 minus 7,600, 40% on it. So this is 7,200. So the UK tax on overseas property income is 3420. So it's 10620 pounds. So obviously the DTR is lower off and 10620 is lower. So 10620 is lower. So this gives me my tax payable of how much? 55,880, which is 45,260. I will repeat it again so that if someone has any query, it gets cleared. Let me repeat it again. See, this is an 8 marks requirement. Believe me, it is such an easy requirement. I would say that June 2022 paper is one of the easiest paper in the history. It is one of the easiest paper in the history of ATX. Okay, because when I look at this paper and I'm solving it with you, believe me, the examiner has given so easy marks. He has given cash marks to the students. But then also, if you will look at the pass rates, they are around 42%, which means that still 58% of the students are unsuccessful. Why? Because you people don't practice complete papers, and when you look at the exam scenario, you get confused. You are not able to identify the points. Okay, let me repeat it again. See, first of all, we took employment income of 8 months. Why did I took employment income of 8 months? Let me add a footnote here. It is very much better that if you add footnotes, small explanations for what you have done in the question. Note 1. Hogan became UK resident from the date he took up permanent employment in UK on 1st August 2022. Okay, because it was written in the question that split year basis will apply. It was written in the question that split year basis will apply in 22-23, which means he will become resident from the date he started his employment. And he told us that don't go in the explanation, just consider that split year is getting applied. Hogan became UK resident from the date he took up permanent employment in UK on 1st August 2022. His taxable employment income in 2022-23 is of 8 months. Okay, from 1st August 2022 to 31st March 2023. Are you people getting it? Please give me feedback. Are you people understanding it? Okay. Now, then there is overseas property income. The overseas property income is 25,600. Now I will add a note 2 here. I will add a note 2 here. Okay. Now see, overseas property income will only be subject to UK tax once Hogan became UK resident too. When he became UK resident. Now see, the overseas property income is coming from the month of July, but I'm not taking it from the month of July. I will consider it from the month of August. He became UK resident. Okay. Overseas rental income will only be subject to UK tax once Hogan becomes UK resident. Hogan will become UK resident from the date he took up permanent employment from 1st August 2022. Taxable property income of Hogan in tax year 2022-23 will be of 8 months. Yes, you can explain these comments in the comment tab, like in the table also you can comment it. But what I normally do is that the comments which are a bit lengthy, I write them at the end. At the calculation support, I write here in the comment box. But both are acceptable, there is no issue in it. Whatever you feel feasible is right. Okay, so overseas rental income will only be subject to UK tax once Hogan becomes UK resident. Hogan will become UK resident from the date he took up permanent employment from 1st August 2022. Taxable property income of Hogan in the tax year 22-23 will be of 8 months from August 22 to 31st March 23. Then there is personal allowance. We have already explained it. There is personal allowance. We have already explained it. Okay, then there is taxable income. The personal allowance has diminished because the income is exceeding the threshold. Then there was income tax on 37,700, it was 20%. Then till 150,000, it was 40%. Then on the excess, it was 45%. Okay, then there was income tax. Double taxation relief will be available on overseas rental income. Why double taxation relief will be available? Because overseas rental income is also taxed in overseas at 45%. It is also taxed in overseas at 45%. Since there is double tax, so you will get a double taxation relief. Okay, so this gives you the tax payable. Let me read the requirement if we have left anything or we are done with it. Calculate the Hogan's income tax liability for this tax year. See, we have calculated the income tax. Okay, then you should include an explanation of the amount of Hogan's property income which will be subject to UK income tax in the tax year. So I've also given the explanation that how much rental income will be subject to UK tax. Is there anything left? It's over. How many marks are done? 8 marks. Believe me, it was the easiest requirement. It was not difficult. Just what you people need to understand is that when you do the past paper question, when you are attempting in the exam, be relaxed. Don't get frustrated. Don't rush. Be relaxed and do it in the relaxed manner. The things will automatically start solving. See, if you look at it, it was a very basic question that we added the income, the personal allowance was diminished, we calculated the tax, then there was double tax relief, we commented on the notes. It was very straightforward. Okay. Now, one student is asking that, sir, is it necessary to put the pound sign? It is not necessary. It is not necessary. If you will add a pound sign, it is good. If you forget about it, there is no issue in it. Number one. Number two, if you add the pound sign on the top of the table, then it is not required that you add in every point. Okay, so it is not an issue. You can just put it on the top of the table, and then you are not required to add along with every number. Okay. What about what about adding the comma in the numbers? No issue. Okay, you can write it like this also, 16,500. But I personally like complete things, so that's why I put everything. But it's my habit. If you get time in the exam, it's better to write the pound sign, put the comma. But if you forget, then there is no issue in it. Okay. Now, so sir, shouldn't we do this type of question in the spreadsheet? Yes, you can do it in the spreadsheet. I told it in the previous class also. The examiner allow that you can solve it in the spreadsheet also, the tables, and you can solve it on the word processor also. It is allowed in both of them. My personal opinion is that solving the entire question on one screen is more easy. Okay, but if you like to solve it on the spreadsheet, that is also completely acceptable. Okay, that is completely acceptable. But I personally think that changing the screen, going on the spreadsheet, coming back on the word processor, this wastes a bit time. So that's why I prefer with word processor. But if you would have solved it on the spreadsheet also, then also it is acceptable. Okay, you can solve it in thousand also. One student is asking that, sir, like if you put 000, so can we write in thousands? Yes, you can write. That is also acceptable. See, the examiner don't deduct mark for these small things, like for putting a comma, for putting a pound sign, writing in thousands. It's not an issue. Okay, whatever suits you is good. Now, let's move forward. I want you all to concentrate on it. I hope that this requirement is good. Okay. Now, let's move to the second requirement. Award of free shares from VPR PLC share incentive plan, a small requirement of 3 marks. A small requirement of 3 marks. Award of free shares from VPR PLC share incentive plan. Let me read it. State the conditions which must be satisfied in the future. State the conditions which must be satisfied in the future in order for there to be no income tax payable by Hogan in respect of the value of the shares awarded to him and the dividend paid in respect of them. What are the conditions if you want that there is no tax on share incentive plan shares? Please tell me, what are the conditions which you need to satisfy? There is a very simple condition that you have to retain the shares for 5 years. You have to retain. See, he is not talking about award of shares. He has already got the shares. He's talking about the future. He's talking about the future. So 5 years retention is necessary in respect of the shares. And for the dividend, it is necessary that you use the dividend to purchase further shares. You use the dividend to purchase the further shares. See, it is written in the share incentive plan. Any dividend received on these shares will be exempt. Income if used to purchase further shares. SIP shares must be kept for 5 years. Okay, so state the conditions which need to be satisfied in the future in order for that no income tax is payable on the shares. So what are the conditions? I will just copy it from the question. Conditions which must be satisfied in the future in order for there to be no income tax payable by Hogan in respect of the value of the shares awarded to him and the dividend paid in respect of them are, what are the conditions? Number one, Hogan should retain the shares awarded under SIP plan for at least 5 years from the date of award. Okay, so you have to retain those shares. Hogan should reinvest the dividend amount received to purchase further shares, to purchase further shares. Okay, now these are the two requirements which students normally remember. Now there is one more point which is normally not included in the past papers, but you can learn it from the answer. Shares purchased through dividend, shares purchased through the dividend has to be retained for at least 3 years by Hogan. Okay, now this is one of the points which you will not normally find. This is one of the points which you normally don't find in the notes, because this is one of the very small point. I even think that it is not given in the study text also. But if someone would have forgotten it, it would not have cost him more than 1 mark. Okay, what you need to understand is that normal holding period for SIP shares is 5 years. Normal holding period for SIP shares is 5 years. Okay, if you reinvest the dividend amount to purchase further shares, There is no tax. The shares purchased through dividend has to be retained for 3 years. The shares purchased through dividend has to be retained for 3 years. Now, this is one of the point where a student can make an error, because normally the students don't remember this rule, that the holding period requirement is 5 years for normal SIP shares, but for the shares purchased through dividend, this requirement is 3 years. Now, when you do the past papers, you sometimes find these small points which can be helpful for you. Okay, now there is no need. See, one student has asked that, sir, why we are not explaining the two situations, that if we sell before 3 years, then the tax is on disposal proceed. If we sell after 3 years, but before 5 years, then the tax is on lower off, like the rules which are written here. Why we are not explaining them? Because see, look at the marks in the requirement. Look at the marks. There are only 3 marks. So writing so much rules in detail will be like wasting your time. Okay. So I will repeat it again. If you want to understand the concept, let me tell you explain it for you, but it was not required to write in the answer. Now, one student has asked, so like copying and pasting the things from the question, is it right or it's not permitted? It's completely permitted. It's completely acceptable. You can copy and paste the things. Like I paste the requirement, I paste the sentences from the question so that my explanation gets easy and the things get easier for me. Okay, now, see, when you get the shares under share incentive plan, you have to retain them for at least 5 years if you want to make sure that there is no tax on it. Okay, if you sell them before 5 years, there are two situations. Before 5 years, if you sell within 3 years, the tax will arise on the disposal proceed. If you sell within 5 years, there will be tax. If you sell within 5 years, there will be tax. Now, what will be the tax amount? If you sell within 3 years, the tax will be on disposal proceed. If you sell after 3 years, but before 5 years, then tax will be at lower of two things: the disposal proceed and the market value on the grant date. Okay, but this rule was not required to be written in the answer here, because it was just a 3 marks requirement. 1 mark for retaining the shares for at least 5 years, 1 mark for the dividend amount reinvestment, and the last was for the dividend shares. The shares which you purchase through dividend, you have to retain them for at least 3 years. Now, this was one of the points which many students do not know, because it is not written in all the books. But when you do the past papers, you find out these small information, and that can be really helpful in the exam. So if I wouldn't have written it, then what would have happened? You would have lost 0.5 or 1 mark. Is it clear? So I think this was a very easy requirement for 3 marks. Okay. Now comes the 7 marks requirement. Sale of sea breeze cottage, 7 marks. Sale of sea breeze cottage, 7 marks. Do anyone have any query till here? Please ask me if there is any question. Okay, now, okay, one student is saying that he has a question. What is the query? Please tell me. Sir, any gain tax relief, DTR? I will do the gain tax part. I haven't done the gain tax part yet. Okay, there is double tax relief in CGT also. The CGT DTR is available. The double tax relief is available in CGT also. We'll look at it while we'll solve the question. Okay, sale of sea breeze cottage. Okay, so let's look at it. I want you all to concentrate on it. Now, what he's asking in relation to sea breeze cottage. Calculate Hogan's post-tax proceed if he were to sell the cottage for £670,000 now, while he is not a UK resident? Okay, what will be the Hogan's post-tax proceeds? What will be the Hogan's post-tax proceeds if he were to sell the cottage for £670,000 now? Okay, what will be the tax implication if he were to sell the cottage now? Okay, when he is not a UK resident. So when you are not a UK resident, there will be no UK tax on it. There will be only overseas tax on it. CGT is charged at the rate of 4% on disposal of assets situated in Balteria, regardless of the individual's resident status. Okay, but since he is not a UK resident, so there will be no UK tax at this situation. Let me develop the answer. Hogan's post-tax proceed if he were to sell the cottage now, while he is not UK resident. If Hogan will sell the cottage while being non-UK resident, then there will be no UK tax on it. Okay, only overseas tax will be payable. Only overseas tax will be payable. If Hogan will sell the cottage while being non-resident, then there will be no UK tax. Okay, because he's been non-UK resident for last 30 years. If you look at the question, he has been non-resident for last 30 years. He has been living in the country of Baltira. Okay, if Hogan will sell the cottage while being non-UK resident, there will be no UK tax on it. Only overseas tax will be payable. So what will be the overseas tax? Disposal proceed is equal to market value. What will be the disposal proceed? If you look at it, here it was given. The tenant moved out of the house on 28 February and I intend to sell it. The sale proceed would be 670,000 if I were to sell the house now. If he will sell the house now, the sale proceed is 670,000. So the disposal proceed is 670,000 less cost. What is the cost? What is the cost of the house? He purchased it for £360,000. So the cost is 360,000. So this gives us the chargeable gain. What will be the chargeable gain? 670 minus 360. It's 310,000. Okay. Now annual exemption. What will be the annual exemption? Will anyone tell me? Will anyone tell me? The annual exemption is 0. Why is it 0? Because here it is written, chargeable gains are calculated in the same way as they are in UK. However, there is no CGT annual exemption amount in Baltira. Okay, no annual exemption in Baltira. No annual exemption in Baltira. Okay, so the taxable gain is 310,000. Okay, CGT in Baltira is, what is the amount of the CGT? What is the rate of CGT? The CGT in Baltira is at 4%. CGT is charged at the rate of 4% on disposal of assets situated in Baltira, regardless of an individual's resident status. So 310,000 into 4%. So it will be £12,400. Okay, what did he ask from us? He asked us to calculate the post-tax proceed. Post-tax proceed. The disposal proceed was 670,000. The capital gain tax is 12400. So the post-tax proceed is 657600. Okay. See, if you look at the question, is it difficult? Please tell me. Is it difficult? Is there anything in which you can make an error? Please tell me. It's a simple, straightforward question. It's just going in a simple flow. If Hogan will sell the cottage while being non-UK resident, there will be no UK tax on it. It's simple. It is written here that he's non-resident. There is no need to question the data. There is no need to challenge the data. It's simply written here. If Hogan will sell the cottage while being non-UK resident, there will be no UK tax on it. Only overseas tax will be payable. Disposal proceed, less cost, there will be chargeable gain. Annual exemption, there will be taxable gain. Believe me, always the papers are straightforward. I will agree that there will be 15 marks, 10, 15 marks, which will be technical. That is normal. You are going for a professional level exam. There will be 10, 15 marks. There will be 10, 15 marks, which will be technical in the paper. But what you need to make sure is that you don't have to waste the time on them. You don't have to waste the time on them. You just need to move forward. You just need to move forward. You shouldn't be wasting the time on small things. Okay? So if Hogan will sell the cottage while being non-resident, there will be no UK tax on it. Only overseas tax will be payable. So disposal proceed, less cost, this will give the chargeable gain, less annual exemption, which is 0 because there is no annual exemption in Balti law. The taxable gain is 310. And then we applied the CGT. Post-tax proceed, disposal proceed, less the tax. So this gives me the post-tax proceed. Okay, now let's look at the question. What else he's asking? Calculate the Hogan's post-tax proceed if he were to sell the cottage now while he is non-UK resident. Then explain with supporting calculation Hogan's post-tax proceed if he were to sell the cottage for £800,000 in June 2023 when he would be UK resident. What will be the implication if he will sell the cottage in June 23? Okay, what will be the implication if he will sell the cottage in June 23? What will be the impact if he will sell the cottage in June 2023? Okay, Hogan's post-tax proceed if he were to sell the cottage for 800,000 in June 2023 when he will be UK resident. So when he will be UK resident, he has to pay UK tax on it. He has to pay UK tax on it. So let's develop the answer for it. Once Hogan will become UK resident, he has to pay UK CGT on sale of cottage. Okay, once he becomes UK resident, he has to pay UK CGT on sale of cottage. Once he becomes UK resident, he has to pay the UK CGT on sale of cottage. Now, if you look at the property, the tenant moved out of his house. Now, this cottage is a residential property because the tenant is living in this property. It was a house. Okay, it was a residential property. Okay, UK CGT will be at the rate of 28% as cottage was a residential property and Hogan is a higher rate taxpayer, or you can say, and Hogan's basic rate band is used. Basic rate band is already used in income tax. I will repeat it again. I want you all to listen to me carefully. Once Hogan will become UK resident, he has to pay UK CGT. See, it is very clearly written here when he will be UK resident. So when you become a UK resident, you have to pay UK CGT on sale of cottage. Now, UK CGT will be at the rate of 28%. This was the area where a student would have made an error. This was the area where the student would have made an error. Why? Because he would have missed the fact that this was a house. When it was a house, it was a residential property. On residential property, the rates of CGT are greater. They are 18 and 28%. And Hogan was not a basic rate taxpayer because his salary is already high. You have already discussed it in the above part. His salary is 16,500 per month. Now there is a question. If you would have made slight errors here, like you would have forgotten any rule or something like that, what would have happened? What would have happened? It would cost you like 0.5 marks. So the first thing which you need to learn, see, the first thing which you all need to learn is that don't go for perfection. When you are doing the advanced tax exam, it's a professional level exam. You cannot go for perfection. There will be areas where you will forget small things, but nothing to worry. It's completely normal in advanced tax. Even if you will look at the marking scheme of the examiner, listen to me, very important thing. If you look at the marking scheme of the examiner puts 9 marks for a question of 7 marks. What do you mean by this? The examiner puts 9 marks in the marking scheme for a question of 7 marks, which means that even if the student will forget some of the small data, still he can get the complete marks. So the examiner also gives you a leverage in this area. So don't go for perfection. There will be areas where you will forget small things. So once Hogan will become UK resident, he has to pay UK CGT on sale of cottage. UK CGT will be at rate of 28%, as cottage was a residential property and Hogan's basic rate band is already used in income tax. Further, Hogan will also get double taxation relief. Double taxation relief. Why will he get double taxation relief? Because CGT is charged at rate of 4% on disposal of assets situated in Baltira, regardless of the individual resident status, because the overseas tax is 4%. Further, Hogan will also get double tax relief as disposal of cottage will also be subject to overseas tax. However, it will be at Baltirian tax rate, which is, however, it will be at Baltirian tax rate, which is 4%. Okay, the Baltirian tax rate is 4%. You need to remember this, as it is lower than UK tax rate of 28%. Further, Hogan will also get double taxation relief as disposal of cottage will also be subject to overseas tax. However, it will be at Baltirian tax rate, which is 4%, as it is lower than UK tax rate of 28%. Now let's calculate the tax amount. I want you all to concentrate on it. See, what you need to understand is that there will be some small information in which you may make some errors, but that do not mean that you will get a 0 in the requirement. Those small information will hardly cost you 1 or 2 marks. Okay, so now the disposal proceed will be, can anyone tell me? Now what will be the disposal proceed? The disposal proceed, okay, it was written here in the email. Yes. The Hogan's post-tax proceed if you were to sell the cottage for £800,000 in June 2023. Okay, so now the disposal proceed will be £800,000. What is the cost? The cost will remain same. What is the cost? The cost was £360,000. I paid £360,000 for the house. So the cost was £360,000. So what will be the chargeable gain? 800,000 minus 360. The chargeable gain will be 440,000. Okay. Now there will be annual exemption for UK tax. Okay, because you are charging the UK tax, so there will be annual exemption for UK tax, 12,300. So this will give us the taxable gain, 440 minus 12,300. So it will be 427,000. Okay, now you will apply the CGT, UK CGT. So the UK CGT will be 427,700 multiplied by 28% into 0.28. So it's 119,756. Okay. Now you will deduct the double taxation relief from it. DTR will be lower of two things. What is the UK tax? UK tax is 119,756. Now here a student can make an error. Here the student can make an error. The overseas tax will be on 440,000 because in Baltira there is no annual exemption. Do you remember? In Baltira there is no annual exemption. So overseas tax will be at 440,000 into 4%. In Baltira there is no annual exemption. So the overseas tax will be on chargeable gain, 17,600. So obviously this is the lower of 17,600. So the capital gains tax amount will be, can anyone tell me? 119,756 minus 17,600. I will repeat the things again. So if you have any confusion, don't worry about it. 102,156. Okay. Now we have to calculate the post-tax proceed. Okay, we have to calculate the post-tax proceed. So how will we calculate the post-tax proceed? The disposal proceed was 800,000 and the tax is 102,156. So the post-tax proceed will be, one student has asked a question, let me give a second and then I'll reply your query. 697,844. Just give me a second. Okay. Now, one student has asked a question, sir, that if there would be a treaty, then what would have happened? Like when there is no treaty, we calculate DTR at lower of. But if there would be a treaty, then what would have happened? See, what you need to understand is that treaty is the agreement between two countries. When we use the word double tax treaty, treaty is the agreement between two countries. If there will be a treaty, the examiner will write in the question that one country will charge tax and one country will exempt it. If there will be a treaty, he will tell you the situation of the treaty. Normally, when there is a treaty, one country will take tax and one country will exempt it. Okay, one country will take tax and one country will exempt it. Okay, let's review the question again and we'll look at if we have done any error or something like that, because when we review the things, we may identify some of the mistakes or some error we have made. Okay, now first of all, he asked us that Hogan's post-tax proceed if he were to sell the cottage for 670,000 now, while he's not a UK resident. Now, if Hogan will sell the cottage while being non-resident, if he is a non-resident, then there will be no UK tax on it. Listen to me. If he is a non-resident, then there will be no UK tax on it. Only overseas tax will be payable. So we just calculated the overseas tax. We just calculated the overseas tax. Disposal proceed, less cost, it gave us the chargeable gain. In the country of Baltira, there was no annual exemption, so this was the taxable gain, and we charged the CGT on it. And we found out the post-tax proceed. If he is not a resident, then there will be only tax in overseas. But if he is a resident, then he has to pay UK tax, which will be at 28% because it's a residential property. And the basic rate band is already used, so the rate will also be higher. And there will also be double taxation relief. So disposal proceed, less cost. This gave us the chargeable gain. In UK, there will be annual exemption. This gave us the taxable gain. Now the UK CGT is at 28%. The UK CGT is at 28%. Then we deducted the double taxation relief, which is lower of two things: the UK tax and the overseas tax. Now the CGT amount is 102,156. Now we have calculated the post-tax proceed. Now in the post-tax proceed, we have made one slight error. Now see, as I always say, that there are small errors which you can make in ATX paper. See, we wrote the disposal proceed. We deducted the UK tax. Listen to me. We deducted the UK tax from it. The UK tax was 102,156. But we have also paid overseas tax in the question also. If you look at it carefully, we also paid 17,600 in overseas also. We have also paid the overseas tax. Just use your mind. We are paying the net amount of 102,156 in UK. We have also paid some overseas tax, and that overseas tax was 17,600. What we did was we just deducted the UK tax amount. So your post-tax proceed will fall slightly more. 800,000 minus 102,156 minus 17,600. We have paid two tax in this situation. 680,244. Let me repeat it again if some students have got confused. See, what you need to understand is we are paying UK tax of 102,156. Please listen to me. We are paying UK tax of 102,156. Here it is. And along with that, we have also paid overseas tax of 17,600. So the total tax would be the sum. The total tax would be sum of UK tax and the overseas tax. Okay, so we have paid two taxes. So the post-tax proceed in this case will be 680,244. Okay. See, I will repeat it again. If there would be any stamp duty, then we would have considered the stamp duty issues also. Okay. Now, UK CGT was at 28%. The double taxation relief, because there was overseas tax also. The UK tax was 102,156. Disposal proceed less the UK tax and less the overseas tax. This gives us the post-tax proceed. Now, in the above situation, the post-tax was 657,600. And here the post-tax is 680,244. Okay. Let's read if he's asking anything else. What could be the indicator for stamp duty? He will refer something about stamp duty in the question. Okay. Hogan's post-tax proceed if he were to sell the cottage for 800,000 in June 23 when he would be UK resident. And now this was one of the part in which I will agree that in this point some students may make an error. Now this second bullet was a bit technical, but see, I'll say that if you look at this entire requirement, this was the requirement of 7 marks. If you look at this entire requirement, this thing was very easy. Okay. Here in the UK residency part, there were chances of few errors, but still it was not a technical one. But this thing which he has asked, the matters we should draw to Hogan's attention in relation to his post-tax proceed if he were to sell the cottage for less than 800,000 pounds. This was a bit technical one. The matters we should draw Hogan's attention in relation to his post-tax proceed if he were to sell the cottage for less than 800,000 pounds. What are the matters which he should think? What are the matters which he should think? Now, this was one of the part in which the student may make an error. See, Hogan's post-tax proceed. See, while I draft the answer, I'll discuss it with you people. So listen to me. Hogan's post-tax proceed in case of June 2023 disposal is how much? It is 680. It is 680,244. Whereas in case of disposal, now, if we were to sell it now, the post-tax proceed is 657,600. Whereas in case of disposal now, post-tax proceed is how much? It's 657,600. Okay, this means that post-tax proceed is greater by how much? Can anyone tell me? 680,244 minus 657,600. It is greater by 22,644. The post-tax proceed is greater. It is additional by 22,644. Now, what if he sells the cottage for less than 800,000 pounds? What would have happened? What would have happened? See, this post-tax proceed has been taxed at 28% in UK. This post-tax proceed has been taxed at 28% in UK. Okay. Pre-tax proceed difference will be how much? 22,644 divided by 72% multiplied by 100%. I will repeat each and everything, so don't get worried. Just listen to me carefully. 22644 divided by 72 multiplied by 100, it is 31450. Okay, this means that if Hogan will not be able to sell property at a value above, what is that value? 800,000 pounds minus 31450 pounds. See, this 800,000 pounds is the pre-tax amount. Okay, 800,000 pounds minus 31450 pounds, it's 768,450 pounds. Then his post-tax proceeds will be lesser in case of disposal in June 2023. I know that some of the students may have got crashed up by now. They may not be able to understand the requirement that what he was asking. I will completely agree with you people that here the requirement was bit vague. And you may have got confused. But see, again, from the exam perspective, I will teach it again and again until and unless you will understand. But from the exam perspective, what I believe is that the student's mind cannot go in that much technicality. What I believe is that in the exam situation, the student's mind cannot go in that much technicality. It's 768550. Now, what he's asking in this requirement, first try and understand it. The matter we should draw to the Hogan's attention in relation to his post-tax proceed if he were to sell the cottage for less than 800,000 pounds. See, this 800,000 pounds is the pre-tax amount. This 800,000 pound is the total proceed amount. This 800,000 pound is the total proceed amount. Hogan's post-tax proceed in case of June 23, 680. Whereas in case of disposal now, post-tax proceed is 657. This means that post-tax proceed is greater by 22644. The post-tax proceed is higher by 22644. Now this post-tax proceed of 22644 is facing a total tax of 28%. It is facing a total tax of 28%. If we are paying any overseas tax, it is adjusted in DTR. The total tax is 28%. We are not paying anything more than 28%. This post-tax proceed has been taxed at 28%. Now, what I am doing is that I am working it back. I'm working it back to the pre-tax amount. I'm working it back to the pre-tax amount because I have to comment on this 800,000 pounds. I have to comment on this 800,000 pounds. So I am working it back. 22644 divided by 72 into 100%. So the work back amount is 31450. That this means that if Hogan will not be able to sell the property at 768550, then his post-tax proceed will be lesser. Now please listen. What you people do is, you people gauge, measure the difficulty of your paper through this one requirement. See, we are almost done with 2 questions. This is only one small heading. Now, if I would be in the exam instead of you, if I would be in the exam, I would have simply ignored this requirement. This particular heading, not the entire requirement, this particular heading. What would have happened? See, what would have happened? Look at the entire answer. Look at the entire answer. Hogan's post-tax proceed if we were to able to sell the cottage now. Okay. Now, this was very easy. That if he is not a UK resident, then there will be only tax in Baltira. This was very much straightforward. Okay. There was no issue in it. There was no issue in it. If he will become resident, then he will pay UK tax. There will be DTR. There was no issue in it. Now there was one question that if he were to sell the cottage below 800,000 pounds, what he should consider. See what he's asking. The matters we should draw to the Hogan's attention. The matters we should draw to Hogan's attention in relation to his post-tax proceed if he were to sell the cottage for less than 800,000. See, we made this calculation at 800,000 pounds. We made this calculation at 800,000 pounds. But what if he will sell it at less than 800,000 pounds? Then what will happen? Hogan's post-tax proceed in case of June 23 disposal is 680. Whereas in case of disposal now it is 657. Okay. This means that the post-tax proceed is greater by 22644. This post-tax proceed has been taxed at 28%. Now, what he is asking, if he were to sell it at less than 800,000 pounds, see this 800,000 pound, this 800,000 pound is not the post-tax amount. This is the pre-tax amount. So what I am doing is I am converting it into pre-tax amount. The tax is charged at 28%. I am converting it into pre-tax amount. This means that if Hogan will not be able to sell the property at a value above 768, the post-tax difference is 22644. The pre-tax difference is 31450. Now he's saying that if he sells at a lesser value, then how much less? How much less? It can be a difference of 31450. Okay. Sir, how much marks should be allocated to this specific heading? Maximum 2 marks. Maximum 2 marks. I completely agree that this was one of the requirement where you may have made an error. Now, this was one of the heading which could only be done by an extraordinary student. Okay. So this means that if Hogan will not be able to sell the property at a value above 768, then his post-tax proceed will be lesser. So he has to sell it at least at 768. Okay, he has to sell it at least at 768. Please tell me if I'm able to make myself clear or not, or still you are not able to understand. I can repeat it again. Just don't know how we will remember it. See, this type of thing will not come again. These are I would say that these are the trick questions. Now, these trick questions come like one time or very rare. At least it will not come in your current exam. Okay, it was a trick question. Now, what I would say that this part, this heading, particularly do not require too much knowledge of tax. This requires good knowledge of maths. This requires good knowledge of maths, not good knowledge of taxation. Okay, because doing up the gross up working, looking at the difference, this has nothing to do with the taxation matter. Okay, let me repeat what we have studied till now. The first requirement was very easy. Hogan's income tax liability, employment income, overseas property income, a straightforward requirement. Okay, that was a simple requirement that he became resident from August 22 and we calculated the simple tax. Then there was a simple requirement in relation to award of free shares. That was completely simple and easy requirement. Then comes the sale of Sea Breeze Cottage. Hogan's post-tax proceed if he were to sell the cottage now. Now he's not a resident. Now he's not the resident. It is written while he's not resident. While he's not resident. So if he's not resident, he will only pay overseas tax. The overseas tax is 4%. But once he becomes UK resident, he has to pay tax at 28%. He has to pay tax at 28%. Okay, we calculated the UK tax. The overseas tax was on chargeable gain because in Baltira there was no annual exemption. In Baltira there was no annual exemption. CGT post-tax proceed. Now, he said that if he were to sell it at a lesser value, then what he should consider? The difference between two post-tax proceeds. The difference between two post-tax proceeds. One was 682.44 and one was 657.600. The difference between two post-tax proceeds was 22644. So, if we were to sell it less than 800,000 pounds, this 800,000 pounds, this 800,000 pounds is a pre-tax amount. So what I did was that I converted this post-tax difference into pre-tax. I converted it into pre-tax. And then I said that the minimum sale value should be 768,550. Okay. One student is asking, sir, I cannot find the summary notes. You have to click on the handouts tab. The summary notes are available there. Or you can message me after the class, I'll share you. So it means that if he sells it at less than 768,550, then the post-tax proceeds will be less than 657,600. Yes. Yes. If he sells at a lesser value, then his post-tax proceed will be less than what he's getting now. Okay. One student is saying that, sir, I'm really good on calculation, but I get confused on these type of requirements. What do you suggest? My suggestion is that ignore these type of headings. Don't waste your exam time. See, what you people do is, like, if you will do it in the exam, it will at least take your 15 minutes. Now just do a cost benefit analysis. You are spending 15 minutes on a 2 marks requirement. And even after 15 minutes, you will still be confused on it. So it's better that when you read a particular heading, you are doing this part B and you this part C, and you know that this entire part C is of 7 marks. This entire part C is of 7 marks. You are done with all this, you are done with all this, and then you get confused here. Simply leave that heading. Don't waste your time. Okay. Sir, tell me something. Is it correct to assume that once a question is dealing with overseas income, DTR would have to be calculated? Yes, the DTR is normally calculated unless it is stated in the question that there is a double tax treaty. One time I remember there was a question in advanced tax where it was written that there is a double tax treaty. Now, when there is a double tax treaty, one country will completely waive the tax. Then there will be no DTR. But normally in advanced tax exam, there will be no treaty and you have to calculate the DTR. One student is saying that, sir, I feel difficult while understanding the question. I have one question from you. We have done this entire question. Where did you felt difficulty? Please highlight me. Where did you felt that it's getting difficult? What you people do is that you get confused for these small requirements. Okay? Don't get yourself stuck in the technical ones. Sir, in the last requirement about this one, I told you at the very start, this was one of the requirements which shouldn't be attempted in the exam. You should have simply ignored it because you can only get confused in this heading. Since you are studying with a tutor, I can teach it, but when you are going for your own, you will only get confused in the exam. So beside these 2 marks, believe me, rest all was easy. There was no issue of the requirements. So making your conclusions based on 2 marks, I think this is not the right approach. See, first try and understand. You are going for advanced tax exam. It is one of the last exam of the ACCA. So obviously there will be 5-10 marks which will be technical. So give your best in them. I'm not saying that leave them completely. Give your best, but don't get frustrated. Okay, don't get frustrated. Okay, now let's move forward towards the last requirement, which is gift. This is also a very easy requirement. Gift of 380,000 to a discretionary trust. Okay, gift of 380,000 to a discretionary trust. It's a 7 marks requirement. But before going for it, we'll go for a small break because I know that by now you all have your batteries have ended. Okay, so let's take a break of 15 minutes. Okay. Okay, so we are resuming back. Is everyone back? Please confirm me. In ATX, reading the technical article is not very much necessary. So, not mandatory to read the articles. If you read it, it's good, but not mandatory. Okay, so we are going towards the part D, which is gift of £380,000 to a discretionary trust on 1st July 2023. It's a 7 marks requirement. For examiner report also, if you read for a few papers, it's good, but again, it's not mandatory. Okay, let's look at it. Your more focus should be on doing the past paper practice. Trust. I'm planning to create a UK discretionary trust for the benefit of my two nieces. On 1st July 2013, I will give £380,000 in cash to the trust. This cash will be transferred to the trustees from my bank deposit account in Baltira, and I will pay any inheritance tax due in respect of this gift personally. Now, since the deposit is of Baltira, so it is an overseas asset. I hope you all remember. Since it is a deposit in Baltira, so it is an overseas deposit. Okay, it will only be subject to UK IHT if Hogan is UK domicile holder. In IHT, we look at the domicile status. I have not made any previous lifetime gifts. Now let's go and read some detail which is given here. Hogan was born in UK and has a UK domicile of origin. He is currently neither domiciled nor deemed domicile in UK in respect of all taxes. But you should bear in mind that domicile status may change over time. Okay. Now, if you remember, if someone was born in UK and he had a domicile of origin in UK, he become deemed domicile holder for IHT purpose if he is resident in the year of gift. Please listen to me. If he is UK resident in the year of gift and he was resident in any of the previous two tax years. If you will go to the summary notes and you will search deemed domicile. Okay. Now, deemed domicile is in IHT also. The deemed domicile concept is in IHT also, and the deemed domicile concept is in income tax also. Currently, we are talking about IHT. See, people who are formerly domiciled residents, individuals who are born in UK, have a domicile of origin, are UK resident in the current tax year, and have been resident in any of the previous two tax years. Now let's look at Hogan. Let's look at the status of Hogan. Hogan is making gift on what date? July 23. Hogan is making a gift on what date? July 23. Now July 23 means 23-24. July 23 means 23-24. Now, if you look at the question, in 23-24, Hogan is a UK resident. In 23-24, he is a UK resident. So number one, he was born in UK. He has domicile of origin. He is UK resident in the year of gift and have been resident in any of the previous two tax years. So he had been resident in the previous year 22-23 through split year basis. Okay, let's read the requirement. What he's saying: explain by reference to Hogan's domicile why this proposed gift will give rise to UK IHT liability. Okay, why this gift will give rise to UK IHT liability. Now listen to me carefully while I draft the answer. Gift of £380,000. Gift of £380,000 by Hogan to trust from Baltirian bank account will be regarded as a gift of an overseas asset. As a gift of an overseas asset. it will only be subject to UKIHT if Hogan is a UK domicile holder. Okay, or you can say if Hogan is UK domiciled. See, the first question is not to calculate the tax. Explain by reference to Hogan's domicile status why this gift will give rise to UKIHT. So first of all, I said that gift of £380,000 by Hogan to trust from Baltinian bank account will be regarded as a gift of an overseas asset. It will only be subject to UKIHT if Hogan is a UK domicile. If Hogan is UK domiciled. Now, Hogan do not hold actual UK domicile. It is written in the question. Hogan do not hold. Hogan, he is currently neither domicile nor deemed domicile. Okay, Hogan do not hold actual UK domicile currently. However, he may be subject to deemed domicile status. He may be subject to deemed domicile status as following conditions are satisfied. Now, what are those conditions? Number one, Hogan was born in UK and he had domicile of origin in UK. He is UK resident in year of gift. He is UK resident in year of gift. Gift is made on 1st July 2023 and Hogan is UK resident in tax year 2023/24. And the third one, he was UK resident in previous tax year of 2022/23. This satisfies condition of being UK resident in any of the previous 2 tax years. Okay, I will repeat it again. Listen to me carefully. Considering deemed domicile status of Hogan, he will be subject to UKIHT on gift of deposit from overseas bank account. I will repeat it again. I want you all to concentrate on it. Okay, let's look at it. First of all, he asked us, if you look at it carefully, first of all, he asked us, explain by reference to Hogan's domicile status. Explain by reference to Hogan's domicile status why the proposed gift will give rise to UKIHT. Okay, with reference to domicile status, first explain that why it will give rise to UKIHT. So we stated that gift of £380,000 by Hogan to trust from Baltinian bank account will be regarded as a gift of overseas asset. It will be subject to UKIHT if Hogan is UK domiciled. Okay, one student is asking, sir, why are we not talking about remittance basis? Remittance basis is issue of income tax and CGT. We are currently talking about IHT. What are you doing? It's just 1 week to the exam. You shouldn't be doing such a mistake. We are talking about IHT status. In IHT, the IHT will only apply if you are UK domicile holder. Yes, all the conditions have to be satisfied. Gift of 380,000 by Hogan to trust from Baltinian bank account will be regarded as gift of overseas asset. It will be subject to UKIHT if Hogan is UK domicile. Now, Hogan do not hold actual UK domicile currently. However, he may be subject to deemed domicile status as following conditions are satisfied. Number one, you are born in UK. Number two, you have domicile of origin. Number 3, you are UK resident in current tax year. C, the gift is made in July 23. The gift is made in July 23 and it is clearly written here that Hogan will be UK resident in the tax year 23-24. So yes, he is resident in the current tax year. And number 4, have been resident in any one of the previous 2 tax years. So yes, he was resident in the previous tax year of 22-23. Okay. So has been resident in the previous tax year. Sir, if you would have forgotten any one of the condition, then what would have happened? You would have lost few marks like 0.5 or 1 mark. Okay. Sir, I always get confused to see if a person is UK resident or not. Now, in this question, it was clearly written here. Why are you getting confused? Hogan will be UK resident in the tax year 23-24. Why are you getting confused in it? It was simply written here. In the previous year, it was in 22-23, the split year basis was applying. You yourself wrote in the requirement above. You yourself solved it that Hogan will become UK resident in 22-23. So there is nothing to get confused. Okay. So please make sure that you don't make mistake in the easy marks. Okay. So the first thing which he asked was that explain by reference to Hogan domicile status why this proposed gift will give rise to UKIST. So it will give rise to UKIST because he is deemed domicile holder. Now the second thing is he's asking is calculate the amount of IST. Let's calculate the amount of IST. Not a big deal. Not a big deal. What is the value of transfer? What is the value of transfer? So the value of transfer is 380,000 pounds. The value of transfer is 380,000 pounds. You will deduct annual exemption from it. Okay. Annual exemption, current year and last year. You will deduct annual exemption from it. 6,000 pounds, 3,000 for current year and 3,000 was for last year. So this will give you chargeable lifetime transfer. What is the value? 374,000. Okay. Now you will apply lifetime tax on it. What will be the lifetime tax on it? On first 325,000, as it was written that he has not made any other gift. So 325,000 into 0 is 0. And then 374,000 minus 325,000. See, it was written in the question that donor is paying tax. So you will apply 25%. You can read it here. I will pay any inheritance tax due in respect of the gift personally. So this means that donor is paying tax. I have not made any previous lifetime gifts. This means annual exemption is also available and nil rate band is also available. So 25% tax will be 374 minus 325 into 0.25. So it's 12,250 pounds. Okay. So the total IHT will be 12,250 pounds. See, believe me, if someone thinks that this is difficult, I must say that now this is his wrong judgment. There is nothing difficult till here. What I personally believe that this was one of the easy requirement. What is difficult in this? And he gave you 7 marks for this working. Okay. He gave you 7 marks. The annual exemption is available whenever you are calculating IST of current year and last year both, except if the last year exemption was used. Okay. So see, this was some very easy thing for 7 marks. Now those students, let's talk to those students who were saying that, sir, it is very difficult. Now see, you were making decision on these 2 marks. These 2 marks you were making decision. What about these easy 7 marks which examiner gave to you? What about these 7 marks? What you need to now just look at the entire question. The whole question is done. Look at this entire question and identify the marks which were difficult. Just identify it. This income tax liability, this was something very much straightforward, very much straightforward. You all yourself said that this was easy one. Then award of SIP shares, very straightforward. Then sale of cottage, if non-UK resident, if UK resident, only these two marks, the which were for less than 800,000, that were a bit technical. And then look at these last 7 marks. Such a piece of cake, I would say. Okay. First of all, he asked that why it will be subject to UK IHT. First of all, he said that why UK IHT will apply. So you said that he is deemed domicile holder. He is deemed even the examiner gave you a hint. If you read here, even the examiner gave you a hint. But you should bear in mind that domicile status may change over time. He gave you a hint that there was some change in domicile status also. He even gave you in that hint. He was born in UK and had a domicile of origin. So you have to think about formerly domiciled people. Okay, so what you need to understand is that when you go for the examination, you have to attempt the paper with confidence. Don't rush in the exam. What you people do is that you rush in the exam, and as a result, you people get in difficulty. Don't rush. Attempt the paper with confidence. Believe me, it is always easy. It is always easy. It is never difficult. Okay, so is it clear in relation to question number 2, or you people want to ask anything? So if we calculate NRB in future, how much chargeable gain? We will gross up the transfer. For the debt tax, we will gross up the transfer because donor is paying tax. We will gross up the transfer value because whenever the donor pays tax, we gross up the transfer value. Okay. So if you look at the discussion we have done till here in the webinar session, we started with the question 1 in the previous class. We started with the question number 1 in the previous class, which was very easy one. And now we have moved to question 2, which is also done. Okay. Now let's move towards the next question, which is question number 3, and see if there is anything difficult in it. Question 1 and 2 are done. Let's move towards question number 3. Okay, just listen to me carefully, and believe me, you will be able to do it in a very easy manner, and there will be nothing difficult in it. Let's look at it. Okay, anyone, if anyone want to ask in question anything in the question 2 which we have just done? Any query? Okay, I think that there is no query, so let's move forward. You should assume, now we are moving towards question number 3. You should assume that today's date is 1st June 2020. The overseas aspect was covered in this part in question 2. What do you want to ask in this overseas aspect? You can ask me. What do you want to ask? We discussed relating to the overseas income. We covered the double taxation relief. Okay. The deemed domicile concept is in income tax and IHT both. I told you the deemed domicile concept is in income tax and IHT both. This deemed domicile is in IHT and deemed domicile is also in income tax. In income tax, if you will go to individual overseas, there is deemed domicile in the IHT and CGT also. Okay, it is in both of the concepts. Since currently we were doing IHT, so we went to deemed domicile status in overseas IHT. Okay, these are the conditions in IHT. When you talk about income tax and CGT, you will just go forward in the summary notes, and these are the conditions for the income tax and CGT. Okay. One student is asking that, sir, in the examination, sir, please repeat. What do you want me to repeat? Please tell me. The student asked me that, sir, deemed domicile is only in income tax and CGT. So I was making it clear that the concept of deemed domicile is in IHT and it is also in income tax and CGT. It is in both topics. In IHT, for formerly resident, We look at the residence status of the previous 2 years. In income tax and CGT, there is only the requirement for current year residency. So the concept is in both of the topics. Okay, that was what I was telling to her. Okay. Sir, IHT domicile and CGT difference. I think, yes, I'm telling that the deemed domicile concept is in IHT also, and it is in CGT and income tax also. Okay. Now, one student has asked me that, sir, I face difficulty in time management. My time runs out in the exam. See, what you need to understand is that there is no shortcut for time management. You need to practice few papers before going to the exam. What happens with you people is that when you go in the exam, you are not prepared to deal with all the questions in a limited time. And as a result, you spend more time on some requirements where you would have to spend lesser time. So, in order to improve your time management, what you should be doing is that you should practice more and more papers on the exam software with a time restriction. Keep a clock and end your paper at 3 hours and 15 minutes. And then identify that what were the errors you were doing. Where were you spending greater time? The only solution is practice. When you will practice few papers in the exam situation, you will be able to overcome the time management issue. This is the only solution. Okay. And one piece of advice, always remember that there is almost 1.8 minute per mark. There is 1.8 minute per mark. Like if the requirement is of 7 marks, you have to spend almost 12 minutes on that. Once your 12 minutes are done, leave the answer till the point you have done and move to the second requirement. What you people do is that you spend extra time on the starting requirements. Then by the end, you run out of the time. If your time for a particular requirement has been completed, move to the other requirement. In this way, you will be able to keep in mind that, okay, I have to go back and I need this much time. So you will automatically save time in the future requirements. And in this way, you will be able to complete the whole paper. And when you complete the whole paper, you are able to find the easy marks also. See, what you need to understand is that sometimes you spend extra time on difficult requirements. Sometimes you people spend extra time on difficult requirements. This is where you run out of the time. So whenever your time for a particular requirement is done, stop it there. Move to the next part. When you will follow this approach, automatically your time management will improve. Okay? One student is saying that, sir, should I go for section A first or section B first? My advice is that you should solve the paper in sequence. You should solve the paper in sequence. And whenever you face difficulty in any of the requirement, just leave it for the end. Like when you are doing question number 1 and you feel that in part B, it will be difficulty. So leave it for the end. Move throughout the paper in sequence. But if you are more comfortable in doing section B first, then you can do section B first also. There is no issue in it. Okay, it is completely acceptable what approach suits you. But my personal opinion is that the student should go throughout the paper in sequence. And whatever requirement he feels difficult, he should leave it for the end. Okay, let's move to question 3. Now, you should assume that today's date is 1st June 2022. The finance director of Fox Limited has required advice on the chargeable gain implication of the assignment, sale of existing lease, the subsequent acquisition of a freehold factory, and the availability of group relief in respect of a trading loss. We'll look at it in the detail when we'll read the exhibit. That is just an introduction. The following exhibit available on the left-hand side of the screen provides relevant information. So let's read the first exhibit, Fox Limited. I want you all to concentrate on it. Now, Fox Limited Group at 1st June 2022. Fox Limited owns 90% shares in Bravo Limited. It acquired it in 1st May 2014. Okay, 100% shares in Salis Limited. It acquired it on 1st April 2022. And then 80% shares in Coro Limited, acquired on 1st July 2019. So if I look at the group structure, direct holding 90, direct holding 100, direct holding 80. But if I calculate indirect holding in Coro Limited, if I calculate indirect holding in Coro Limited, 90 into 80, if I calculate the indirect holding, 90% into 80%, it's 72%. If the indirect holding is 72%, you can form capital gains group with Coro Limited, but you cannot form the 75% group. I will repeat it again. Fox, Bravo, and Salis. Fox, Bravo, and Salis. These three can form capital gain and 75% both. These three can form capital gain and 75% both. But when you talk for Coro Limited will be part of the capital gains group, because in capital gains group, indirect ownership requirement is 50%. Coro Limited will be part of capital gains group because in capital gains group, indirect ownership requirement is 50%. But it will not be part of 75% group, because in 75% group, indirect ownership should be at least 75. I will repeat it again. For 75% group, direct and indirect, both must be 75 for 75% group. For capital gains group, direct should be 75 and indirect should be 50. So this Coro Limited, the indirect ownership 80 into 90, it's 72%. At 72%, 75% group cannot be formed, but capital gains group can be formed. We'll look at it further detail while we read the question. Sir, one company can be in a 75% group and capital gains group? Yes, we can be part of 75% group and one capital gains group. Okay, we can form two groups of different types, 175, one capital, but it is not possible to form two capital gains group. 175, one capital, it's acceptable, but it is not possible that you form two capital gains groups. Okay. Fox Limited assignment of lease and acquisition of a new freehold factory. On 1st October 2021, Fox Limited assigned a 26 years lease on a factory to an unconnected company for 180,000. This means he disposed of a lease. When you dispose of a lease, we write disposal proceed and then we write the adjusted cost. I hope you all remember the rule of disposal of lease. The lease has been acquired by Fox Limited on 1st October 2007 for £102,000 when it had 40 years remaining. The lease factory was used by Fox Limited for trading purpose throughout its period of ownership. Now, Fox Limited sold an office building in March 2007. I'm talking about March 2007, which resulted in a chargeable gain of £43,000. Fox Limited claimed rollover relief in order to defer this chargeable gain following the acquisition of the lease of the factory, which means that the gain of the office building was deferred against this lease factory. Fox Limited plans to purchase a new freehold factory building in July 2022. Now, this is some detail given in relation to Fox Limited. Then we have information relating to Coro Limited, and then we have information relating to Salis Limited. Let's read the requirement. Now see, in section B, please listen to me. In section B, it is possible that when you read information of one company, you can solve the requirement relating to that company. Because in section B, normally the requirements are demarcated, they are separate. Like if I read part A1, calculate the chargeable gain arising on the assignment of lease on 1st October 2021 and explain the tax treatment of this deferred gain in respect of the sale of the building. Okay? Yes, normally in the paper, question 1 or question 2, one will be individual and one will be corporate. In section B, it's a mixed variation. Like you can expect corporation, you can expect individual. The format is normally same. Okay, so let's read part A1. Calculate the chargeable gain arising on the assignment of the lease on 1st October 2021 and explain the tax treatment of the deferred gain in respect of the sale of the office building. The following lease percentages should be used where necessary: 26 years, 40 years. You should ignore the indexation allowance and any potential claim for rollover relief in respect of the disposal of the lease. How many marks? 4 marks. Okay, so this part A1 is relating to the lease only. This part A1 is relating to the lease only, so I can solve it from this information. Let's look at it. I want you all to concentrate on it and participate with me while I develop the answer. Question number 3, Fox Limited. This is the requirement. Calculate the chargeable gain arising on the assignment of the lease. Calculate the chargeable gain on the assignment of the lease. Can anyone tell me how will I calculate it? Can anyone tell me how will I calculate the gain on assignment of the lease? Disposal proceed. What is the disposal proceed? On 1st October 2021, Fox Limited assigned a 26-year lease on a factory to an unconnected company for £180,000. So the disposal proceed is £180,000. Now from this, we will deduct adjusted cost. We will deduct adjusted cost. Why adjusted cost, will anyone tell me? If the lease is of less than 50 years, if the lease is of less than 50 years, we use adjusted cost because it is a wasting asset. Okay, I hope you all remember. If the lease is of less than 50 years, we use adjusted cost. Now, what was the cost? The cost was 102,000. But at that time, it was for 40 years. When I sold it, it was for 26 years. So, 102,000 divided by 40 years. The 40 years percentage is given here, 95.457 divided by 95.47 multiplied by 26 years, so that it get like with like, 82.496%. 82.496%. Okay, I will repeat it again. I want you all to listen to me carefully so that if you have any confusion, it gets clear. 102,000 divided by 95.457 multiplied by 82.496. So it is 88,151. So this gives me the chargeable gain. 180,000 minus 88,151. So it's 91,849. Why some student gave me a wrong answer? Please confirm me. 180,000 minus 88,151. So it's 91,849. Okay. So let me repeat it again. Okay. Let me repeat it again. See, what did he ask from us? He, first of all, he asked us to calculate the chargeable gain. First of all, he asked us to calculate the chargeable gain on the assignment of lease. First of all, he asked us to calculate the chargeable gain on the assignment of the lease. The lease was disposed of for 180,000. The lease was disposed of for how much? For 180,000. Now it was disposed of when the life was 26 years. It was disposed of when its life was 26 years. It purchased the lease when its life was 40 years. So what we will do is we will adjust the cost. One student is asking, sir, what would be the treatment if the lease would be of more than 50 years? If the lease would be of more than 50 years, you would not have adjusted the cost and you have taken the whole cost directly. In case of more than 50 years, we calculate normal CGT. In case of more than 50 years, we calculate normal CGT. The adjustment is done when the lease is of less than 50 years. Okay, when the lease is of less than 50 years, we divide it by the total period and multiply it by remaining period. These percentages were given here in the requirement. 40 years percentage and 26 years percentage. We divide it with the total period and multiply it with the remaining period. Okay, the cost is adjusted when it is disposal of lease, when it is disposal of lease and lease is of less than 50 years. The cost is adjusted when the lease is of less than 50 years. Is it clear? Please give me a response. Okay, so disposal proceed less the adjusted cost. So now this is the chargeable gain. Now let's move after end. Explain the tax treatment of the deferred gain in respect of the sale of the office building. Now, what was this sale of the office building? See here it was written. Fox Limited sold an office building on 8th March 2007, which resulted in a chargeable gain of £43,000. Fox Limited claimed rollover relief in order to defer this gain following the acquisition of the lease factory. Now a gain was rolled over, against this leased factory. So when we are selling this leased factory, please listen to me again. A gain was rolled over against this leased factory. Now when we are selling this leased factory, there will be issue of making that gain chargeable. Now here there was a chance that some students may make an error. And I can read from your responses, you all are the ones who will make that mistake. Now see, the gain rolled over against the acquisition of the lease must have been deferred through holdover relief. Why holdover relief? Because this leased factory was a depreciating asset. Its life was less than 50 years. See, this was the place where some students may have made a mistake and they may have lost some of the marks. Gain on sale of office building deferred against, which was deferred against leased factory must have been deferred through holdover relief. Must have been deferred through holdover relief, as lease factory was of less than 50 years and it was a depreciating asset from tax perspective. Now, this is the place where the students make an error. You must ask me that, sir, here in the question, he used the word rollover, but you are saying that it must be deferred through holdover. Now, what you need to understand is that examiner always uses the word rollover. Examiner do not use the word holdover in the question. He always use the word rollover. By word rollover, he mean to say deferral. By the word rollover, he mean to say deferral. Okay. Now it is your job to identify that here the rollover relief wouldn't be used and rather the examiner must have applied holdover in reality. Okay. This is where you can make an error. What you need to understand is that examiner will always use the word rollover because by word rollover he mean to say deferral. But we differentiate between rollover and holdover. Gain on sale of office building which was deferred against leased factory must have been deferred through holdover relief as lease factory was of less than 50 years and it was a depreciating asset from tax perspective. Deferred gain would get chargeable on earlier of three things. Can anyone tell me? It will get chargeable on earlier of cessation of business use of leased factory, number one, disposal or expiry of lease factory, and 10 years from deferral of gain. In case of Fox Limited, gain deferred against leased factory on what date? On 1st October 2007. On 1st October, because the factory was acquired in October 2007. Against leased factory on 1st October 2007 may have got chargeable on 1st October 2017 as 10 years were completed on that date. Now, this was one of the comment which I think that the students may have made an error. I would say that yes, this was one of the tricky thing, and this would involve the students to be very alert in the examination specifically. That students don't think about holdover relief normally. Now, this has nothing to do with the understanding of the requirement. This is completely related to remembering the rules. Okay, see what he was saying here. Calculate the chargeable gain arising on the assignment of the lease. Fair enough. This was the chargeable gain. And explain what? The tax treatment of the deferred gain in respect of the sale of the office building. Now, some students have simply argued it through rollover relief. Now, sir, how did holdover came to your mind? It was simple. Since the asset was of less than 50 years, since the asset's life was of less than 50 years, so your mind should have alerted that it shouldn't be rollover, it should be holdover. Okay, in case of holdover, the gain gets chargeable when you cease the business use, when you dispose the asset, and when 10 years have passed. Okay, in case of Fox Limited, deferred gain would have already been charged in October 17. This gain is not deferred. This will get chargeable today. This 91,849 will get chargeable today. We are not talking about this 91,849. This comment is on this thing. Fox Limited sold an office building on 8th March 2007, which resulted in gain of 43,000. This 43,000 pounds must have got chargeable in October 2017. You are mixing two things, my friend. This would be a big blunder. Disposal of lease is something different. Disposal of lease was something different. 91,849 is a gain on lease. It will get chargeable separately. There is nothing to think about it. It's done. Then after and, he said, also think about the gain which was deferred. Also think about the gain which was deferred. The gain which was deferred of the office building. The gain which was deferred of the office building. That gain which was deferred against the acquisition of the lease factory. What will happen about that? So we said that that gain was not deferred through rollover. It was deferred through holdover. Because the lease factory is a depreciating asset. That gain was not deferred through rollover, that was deferred through holdover, because factory was a depreciating asset. Its life was less than 50 years. So we are talking about that deferred gain now. Okay. If you don't remember the rules of the holdover, you can simply go to summary notes and you will write holdover relief. And here are the rules of the holdover relief. Okay. Now again, you all should be now again you all should have become demotivated. That, sir, how will we do it? Take a break, look at the requirement. How many marks were for this part? Only 4 marks. Only 4 marks. So even if you would have done this deferral thing wrong, even if you would have forgotten the holdover relief, you would have lost 2 marks. This calculation was nothing difficult. I believe that this calculation was not difficult. It was simple working of adjusted cost. Is it clear? Please tell me. Everyone, please give me feedback. Are you people understanding it? Okay. So see what I want to, the main objective of these sessions is to teach you people that when you are going for a professional level exam like advanced taxation, never go for perfection. Never go for perfection. What you need to understand is that you have to go for easy marks first. Don't get yourself stuck in the technical ones. See, like if it is a 4 marks requirement, these 2 marks are pretty much easy. Go for adjusted cost, calculate again. For office building, holdover relief should come in your mind. But even if you are not able to identify it, that is not a big deal. It's not a big issue. It's completely normal that in advanced tax you forget some things. Okay, let's move forward. Coro Limited. Coro Limited acquired a warehouse on 1st July 2021 from an unconnected company for 168,000 pounds. Now see, Coro Limited is in the capital gains group of Fox Limited. Coro Limited is in the capital gains group of Fox Limited. Now what he's saying, that Coro Limited acquired a warehouse on 1st July 2021. Uses 70% of the building itself for the trade and the remaining 30% is rented out. Salis Limited. Salis Limited was incorporated on 1st July 20. Was wholly owned by an individual prior to joining the Fox Limited group. Incurred a trading loss in the year ended 30th June 2021. Has no other source of income in any accounting period. So he's telling us some information about Salis Limited. There are no plans to change the nature or conduct of Salis Limited's trade. Forecast results. Salis Limited is expected to incur a trading loss of £225,000 in the year ending June 2022. Now, if you look at the question, we acquired Salis in April. We acquired Salis Limited in April. Now, Salis Limited will make a trading loss in the whole year of June 22. So there will be issue of pre-acquisition and post-acquisition. Salis Limited will make a loss in the whole year. We have acquired Salis Limited during the year. We have acquired Salis Limited on 1st April. Okay, so there will be issue of some pre-acquisition and post-acquisition. Fox Limited, Bravo Limited, and Coro Limited will each have a total profit in the year ending June 22. These companies have always been profitable in the past and will continue to be profitable in the foreseeable future. So something about 75% group loss relief needs to be considered. Let's read the requirement. Part A2. Part A2. In relation to the chargeable gain calculated in Part A1. In relation to the chargeable gain calculated in Part A1, explain with supporting calculation. The chargeable gain which you calculated, this one. The chargeable gain which you calculated. Explain with supporting calculation the extent to which rollover relief will currently be available within Fox Limited Group. Now, what you need to remember is that either you can invest or your group company can invest. Now, Fox Limited has made a disposal. There is a gain of 91,849. Now, either you can invest or your group company can invest. If you remember the question, the group company Coro Limited is making an investment. The group company Coro Limited is making an investment. And the minimum amount which Fox Limited need to spend on the new freehold factory such that full amount of gain can be deferred using rollover relief. So what will be the amount of rollover relief and what additional investment is required? Okay, but we will not go in detail of this requirement today. It's a detailed requirement. It will take 30 minutes. And I know that today we have already done a lot of it. So we'll look at this requirement in the tomorrow's session. Okay, but just giving you a brief. We'll do the calculation in the tomorrow's session. But just giving you a brief, what you need to understand is in relation to the chargeable gain calculated in Part A1, explain with supporting calculation. Number one, the extent to which rollover relief will be currently available. How much rollover relief is currently available? Because a group company is making reinvestment. A group company, Coro Limited, is making a reinvestment. How much rollover is available currently? Okay, how much rollover is available currently? And what additional investment is required? Because I believe whole proceed is not reinvested, so there must be some additional investment. Okay, we look at it Part A2 in the next class. One student is saying that, sir, please repeat this Part A1 for me. See, in Part A1, he said to calculate the gain on the lease. Disposal proceed, less adjusted cost. When we sell a lease, we use adjusted cost. The lease was of 40 years, so I divided it with percentage of 40 years and I sold it when there were 26 years remaining. I believe that this gain calculation is clear to you, or you have any query in it also. Please tell me. This gain calculation is simple. Okay. Then secondly, he asked us to comment on the gain in relation to the office building. See, if you read the question, it was written that some office building was sold in 2007, on which there was a gain of 43,000. This gain was deferred against the lease. This gain was deferred against the lease. Okay, this gain was deferred against the lease. So we have to comment that what will happen to this gain. So we said that this gain was deferred through holdover relief because lease was of less than 50 years. And deferred gain will get chargeable on earlier of these three things. Okay. Now one student is asking, sir, when examiner is saying calculate additional investment required, this type of requirement gets difficult to understand. When we will solve it in the next class, believe me, it will be very easy. Believe me, it will be very easy. Okay, when basically in this part he has not reinvested the whole of the proceed. That's why he's asking the additional reinvestment required. I'll make you solve in the next class. It will be very much clear. Okay, sir, if investment, okay, but just a second, one question I was reading. Sir, if investment made within the group, if the investment is made within the group, then that is not eligible for rollover. The rollover investment is one when one of the group company purchases the asset from outside the group. Within the group, the assets are exempted. In this question, the reinvestment is not made within the group. Coro Limited has acquired a warehouse from unconnected company. Inside the group, the transactions are exempted. So how will it qualify for rollover? One of the group company has made a reinvestment, and by reinvestment we mean in a separate asset. Okay. Sir, can you please explain the difference between 75% group and capital gains group? Through capital gains group, we transfer capital gain and loss. Through capital gains group, we look at rollover relief. In 75% group, we transfer trading losses. We transfer non-trading loan relation losses. 75% group is not for CGT. It is for trading, non-trading loss, property losses. It is for different things. Whereas capital gains group is for capital gain and loss. Okay. Sir, okay. One student is what we will do after this question. We'll like tomorrow this paper will be completed. We'll look at one more paper. Okay. Sir, is there any degrouping charge available in 75% group? Degrouping charge is only in capital gains group. Okay. So I hope all the queries are done. So let me sum up the today's class. Okay, one more question. Sir, I have question from corporation tax. The tax will all in corporation tax, the reliefs are always at 19%. Okay. Sir, in part one, we dispose of lease on 1st October 21, earlier than 10 years. Then 43,000 will be chargeable on 1st October 21. Roman, I think that you are mixing up the things. Disposal of lease is something different, and the gain deferred of the office building is something different. Please, in your mind, first make these two things separate. Make these two things. Disposal of the lease resulted in this gain. This is something different. Okay, this is done. Keep it in a separate box. Don't mix the things. Now let's talk about the deferred gain. The gain of the building was deferred against this factory. The factory which you have sold, one gain was deferred with it. Okay. Now, since that gain was deferred through holdover relief, that gain, not the lease gain, that gain is of the office building. That gain of office building will get chargeable after 10 years. Okay. The gain which was chargeable after 10 years was the gain of the office building, not of the lease factory. Disposal of lease factory is something different. Its gain is 91,849. It is done. It is closed. Forget about it now. Now, after and one thing separate I'm talking. Explain the treatment of the sale of office building. The office building was sold in March 2007. Its gain was deferred with the lease factory. The lease factory was acquired in October 2007. Okay. The gain which was deferred through holdover will get chargeable after 10 years. So the gain which was deferred on October 2007 will get chargeable in October 17. This was a separate thing. The gain which got chargeable in October 17 was of office building. That was separate, different. Okay. Don't mix it with the lease gain. Disposal of the lease property gave a separate gain of 91,849. Then talking about the deferred gain, the gain which was deferred in 2007 got chargeable in 2017 because 10 years were completed. In holdover, it gets chargeable after 10 years. I hope that I have made myself clear. Still, if you have any query, you can call me on my number. I'll explain you further. Okay. So in the today's class, we are done with the question number 2 of June 2022 paper, and we started question number 3. In the tomorrow's class, we'll complete this question 3 and we'll discuss question number 4 also. With that, our June 2022 paper will be completed. Then we'll move towards one more paper and we'll solve few more questions. Meanwhile, my advice would be that you should do few more past papers. Okay, don't waste your time, do few more past papers. This will give you more and more clarity. Tomorrow we will complete this paper, question number 3 and question number 4. Then day after tomorrow we will start a new paper. Okay, I hope that today's session have added value to you. Okay, you people must have learned new things and you people must have gained confidence. Okay, tomorrow we'll complete this paper and we'll look at a few more questions and you will get more confidence. Okay, what you need to understand is that you have to do the paper with confidence. You don't have to go for perfection. If you will go for perfection in the exam, you will always get nervous. You will always get stressed out. Don't go for perfection. Try and go for maximum marks. Okay? When you will go for maximum marks, you will automatically pick up the easy ones. Okay? Thank you, everyone. See you all tomorrow and we'll complete this paper. Thank you.